Hey everyone, welcome to the live stream. So we know that filing your crypto taxes can feel stressful, it can feel complicated. So that's why we wanted to do this session, just to give you the information that you need to get through the process. So with me today, I have two very special guests, both with deep expertise on the space. First is our CEO, David Kemmerer. He's founded this company back in 2017. So, I mean, that's like 100 years in crypto time. Next is head of tax strategy here at CryptoTrader.tax, Jordan Bass. He's got quite the impressive resume. He's got a JD, LLM, and a CPA. So he's a certified public accountant. I forgot what the other two acronyms stand for, but Jordan, how's it going today?
Doing well. How are you doing?
Doing good, doing good. Excited to get the ball rolling here. But first, before we get started, just a short little disclaimer. Um, all the information that you're about to hear is for general informational purposes only. This is not meant to be financial or legal advice. Well, now that we got that out of the way, I do want to get started by highlighting a couple of pieces of news. So the first is that the wash sale rule may be coming to cryptocurrency. I know that this is something that's currently being discussed in the House Ways and Means Committee. So for everyone listening, can you, Jordan, break down a couple things? First off, what is the wash sale rule? And second of all, how would this change affect the average crypto investor?
Yeah. So basically, at a high level, what the wash sale rule does in the traditional equity markets, because it's really applicable to securities, and as people on this stream kind of know, we've been able to take advantage of that fact in the crypto markets. But what it kind of does and what it incentivizes or disincentivizes people to do is to sell stocks that they're holding at a loss. And then in a very, very short period of time, because there's a 30-day window in which you can't do this, but in a very, very short period of time, reacquire that asset, speculate that it's going to go up in value in the future. Of course, that would, in theory, reset your holding pattern, but you've harvested a loss. For tax purposes, you're still invested in an entity or a company that you think is going to provide long-term growth, and you've now effectively had a wash sale where you've got this loss, the benefit of the loss, and the benefit of keeping your investment in this company. So what the wash sale rule effectively does at a very high level, we don't need to go into the exact details because there are certain other aspects of the rule, but it does not allow for that sort of transaction. It will wash that transaction, meaning you will not get the benefit of that loss that you've technically incurred, and you can't execute that sort of transaction to get the financial and tax benefit. The problem that we see in the crypto space, right, is that people, or I guess the problem that the IRS sees in the crypto space, is that people do execute those transactions, and because crypto is not, a security, or maybe some assets could be deemed to be securities down the line, but we're dealing with property. We can engage in that sort of sale, at least up until now, where you have an asset that you dispose of, you harvest, right? With the phrase that we all use in the crypto tax space, we harvest this tax loss. And then if you're long term bullish on that project, on that platform, on that ecosystem, you can buy it back. Now, you don't want to do something where it looks like the entire purpose of that transaction was to harvest that loss, because maybe that transaction also wouldn't be honored by the IRS. But what the IRS is effectively doing, and what Congress is effectively doing by way of the tax code, is getting rid of this kind of tax arbitrage situation in the digital asset space, so that you can no longer do that. Now, there's going to be a lot of things that come up that are maybe gray area in relation to this wash sale, and we can talk about that a little later, of course, but at a high level, that's what's going on, and it's going to maybe treat the crypto markets, the crypto space, as though they are, regulated securities, even if the regulators that would be looking at those assets, like the SEC, aren't the ones overseeing that marketplace. It creates that sort of ability to not harvest your tax losses in one year and then just move forward to the next year and reset everything.
Got it. Got it. And David, any thoughts on this?
Yeah, so from a software perspective, CryptoTrader.tax and all other major cryptocurrency tax softwares, right, do not have wash sales built in, meaning if you sell your Bitcoin and then purchase it back within 30 days, that's booking a loss, which is, as Jordan mentioned, kind of how it's approaching the industry right now. If this rule changes, you won't as easily be able to book those losses and save money on your taxes. On our end, it'll be just a matter of, a couple line code changes to make those changes a reality. And so the reason why we want to jump on this webinar, right, is because if that rule does change and they kind of bring in digital assets into that, kind of guidance, as Jordan was mentioning, then wash sale rules would apply and folks won't as easily be able to strategically tax loss harvest. But there's still ways, as Jordan mentioned, around this. And tax loss harvesting is still very much a real thing. It'll just have this nuance change that's very mirrored to the equities and securities world.
Got it. So let me try to summarize, and Jordan, correct me if I'm wrong here, but basically next year, maybe if this change goes through, if I'm a crypto investor, I holding one of my assets at a loss, and I sell it and then I try to rebuy it a week later, I won't be able to claim that capital loss.
Yes, if this were to go through in digital assets, which is the term that they use in the code, it's the term that they would be using in the code, which kind of brings in a lot of things, not just cryptocurrencies. There could be an all-encompassing sort of thing, which they tend to use broad language to do that in Congress, right? You would not be able to do that, but you could do it. You could execute that transaction, but the loss wouldn't be honored by the IRS. And so when you file a tax return, when you have wash sales for people in the traditional equities markets, let's say on they get a 1099-B from Robinhood, there is a category that will show that this was a wash sale loss, whatever happened on that transaction is not something that you can actually report. You report it on your return, but you don't get the benefit of the loss for that sale. And that is the same thing in theory that would happen in the crypto space. The problem is because people are moving assets across different chains, moving assets across different exchanges, the onus is going to be on the taxpayer, realistically, to report that wash sale. And that makes it a lot more difficult, which really means that the onus is going to be on software companies like CryptoTrader.tax to make sure that it's done properly.
Right. The interesting thing about that is you can do this stuff by hand, right? Jordan, I know you do a lot by hand because, as more protocols and exchanges come out, right? The software companies are playing catch up constantly, right? To integrate with this stuff. So you can do it by hand, but this rule specifically will make it even harder to do by hand because now you have to go and figure out, did this sale of Bitcoin occur within a 30-day window when they bought it? Just from an Excel CSV dump from these exchanges. So it's, just more headache, more nightmare. As Jordan said, software companies like CryptoTrader.tax, it'll be easy for us because it's just, coded into the system. But this, among other things, right, are just creating it an even bigger problem of just onus falling to consumers trying to just be good faith, honorable citizens trying to report their transactions on their taxes. So it is what it is.
Yeah, no, it's rough. It's rough out here for the average crypto investor.
We're trying to help.
So we're doing our best. So one more piece of news I wanted to discuss before we go on to the Q&A is something I'm sure many of you in the audience already know about. Recently, Twitter unveiled the option for users to give Bitcoin tips to one another. So the way that this works is that, let's say I just listened to my favorite band's new album. I really liked it. I can go to their Twitter page, and if they have this feature enabled, I can give them a $10 Bitcoin tip through the Lightning Network. So Jordan, can you tell us a little bit about what the tax implications might be for the sender and the recipient?
Yeah, and this is actually something obviously we've discussed internally because it seems fairly simple, but it could be quite nuanced depending on the relationship between the two parties, and that's really where the tax situation unfolds. If I were just tipping somebody on Twitter, let's say David said something on Twitter, and I've been following him for a while, and I was like, you know what, I want to give him a $10 tip. It's like a gift from me to him. There's no business transaction that's occurring. There's no real reason for me to do that other than like I feel the need to send him that money. Well, that looks like a gift. That looks like a gift like somebody would be receiving that would not necessarily have any tax consequence whatsoever to the recipient, to the gift, to the person that's giving the gift. Obviously, unless it was over a certain dollar amount. And that threshold is actually, for people that are listening that don't know, the threshold to be able to have to file, to be required to file a gift tax return is if you were to gift somebody something in excess of, $15,000 throughout the year. You would have to, file a gift tax return. And that doesn't mean you're going to pay tax on that gift. It's just more of an informational thing that has to be filed with the IRS. So when you're tipping somebody on the Lightning Network on Twitter, you're probably not going to be sending that much money. I mean, maybe you are, I don't know, and you're a very, very gratuitous person, but you probably won't have to worry about that at all. And so ultimately, it's like a tip. It's like you're tipping somebody because you like them. It's out of the detached, disinterested generosity of your heart, right? That's kind of the IRS term for what a gift is. And there's not really much of a tax consequence there unless, like I said, that dollar amount threshold is reached. However, where you get into this weird sort of, is this income? Is this an expense? Does this person have a certain relationship with the person they're paying? It's really, kind of gray area, because if there's a comedian on Twitter that, their whole job is to say funny things and they post great content on Twitter and they're hilarious and I get a laugh out of that and I'm paying them, I'm tipping them because I'm not just happy that they made me laugh. I'm actually paying them because I'm like, wow, this person's content is amazing. They should be compensated for it. Now it looks like that person has actually received income. I don't have an expense. I'm just a person that's maybe possibly paying for a service, but that person that's receiving the funds might have to pick that up as income. And now when they start generating a lot of these receipts, let's say on Twitter, and again, this is all hypothetical, but if they start to receive a ton of receipts on Twitter and it's in the aggregate a lot of money, now we get into the issue of who's going to be reporting this to the IRS to substantiate that this person actually received that amount of money. So that's where the issue comes into play, but it's more so on the content creator side that's doing something in expectation to maybe profit off of it, and they're receiving, tips on Twitter. It's probably not the main use case for what that function is. So it might not be something that is like a widespread issue. It's just something to be aware of for at least the content creators and people that are possibly transacting on Twitter, like they would maybe a la Venmo, where you could have business expenses and you could have income that you're receiving there as well. So that's kind of something you have to be considering, and that's, people have to be aware of that.
Yeah, I think what's interesting about this, and like you mentioned, Jordan, like the vast majority of tips on Twitter, right, will likely kind of be gifts, and that's not actually taxable. What I think is interesting is the functionality, right, that Jack wanted to roll out with Twitter, right, is going to get replicated across many fintech platforms, right? Just the ability to seamlessly send money via cryptocurrency rails. And so again, you get into this, well, who's actually responsible for reporting this income when it actually looks more like income in the future, right, for other services. And so I think we'll see like just these problems continue to abound as more and more, TradFi and then the fintech guys continue to integrate more and more cryptocurrency like offerings to drive growth. So that's when it will get more interesting from like the tax ramifications.
Yeah, I agree with David. And when we discussed this internally, we were saying this is honestly, it looks more of like a proof of concept to see if this works. And if it does, which it will, in my opinion, then like David just mentioned, it will create that secondary aspect of business transactions being facilitated this way. And then reporting requirements, of course, especially with what is a broker. We'll see what happens. So.
Yeah, that's a whole question of its own. Maybe something we can get on in another live stream. But we do have some questions that I pulled from both Twitter and Instagram that I do want to get to. So this first one's an interesting one, and it is a pretty common misconception, you might say. So I'm reading it out. Imagine that I purchase $100 worth of a coin in October. It goes up in value to $300, and I want to take out my initial $100 the next month and leave the remaining amount untouched. Since I didn't realize a profit, do I still have to pay taxes?
Yes, you did realize a profit. You did realize a profit because that $100 that you spent, let's say it was just USD to simplify the example, and you bought something worth $100, and now in that month, I think that's the example you mentioned, Daraj, right? It was a month time frame. It's gone up in value, and now your asset is worth $300. Well, you now have $300 of purchasing power for something that you acquired for 100. So you don't have to sell the whole entire thing to A, trigger a taxable event. You've sold it for something else, so you've triggered a taxable event. But B, you have basis that's allocated per, let's say, per token. So if you bought 100 of these tokens at $1 per, and now it's worth 300, so each token, let's use an example, it's XYZ coin, is worth $3 per token. Well, you sold, 33.33, I guess would be the math there, which is what it would be. And so you have that amount of gain, which would be the spread of that. So we went from $1 to $3. So now in this example, I guess you have a $66.66 gain. So you have a gain because that amount that you used initially has exceeded its initial purchasing power. And the tax terminology you don't need to know, but the way that it works is that you've had a quote unquote net accession to wealth. You were able to acquire something worth more for a smaller portion of what you initially had, and therefore there's a tax liability that is associated with that. And that's just the way that our system works. So while it appears that you put 100 in, you took 100 out, and you've let the rest ride, because of the basis that's allocated per XYZ coin in our example, that spread will result in a gain in that scenario. And it could be the same thing if you have a loss.
Yeah, I think you explained it very well. The one thing I would add on in that scenario is exactly what you said. You have a cost basis on your tax lots. And so, just because you spend $100 of 10 units of XYZ coin, again, your basis for each unit would be $10. If that whole goes up to 300 now, each unit is worth, call it 30. And so by selling off 3 units, now you have, the delta of gain there. So exactly.
Well said. All right, so here's the next question. How are crypto earnings from airdrops and staking taxed?
Great question. So, airdrops are a little different because oftentimes we get airdropped coins that have no value. And if there's nothing of value that you're receiving, then there's no real market for it to be bought or sold on. Then in theory, it's worth nothing. And sometimes, if you guys remember, for people in this stream that have been around since 2017, let's say, during the crazy ICO craze, there were a lot of tokens being airdropped. They were more like advertising tokens, like just random names that people would see in their wallet and they wouldn't know what it was, and they had no value. And those airdrops, of course, wouldn't be taxed because there's zero value. They're never going to have value. They're really just a random sort of token. But airdrops more upon, the likes of the Uniswap airdrop, or something that the US individuals weren't allowed to participate in, the DYDX airdrop. There is a market for that token when you receive it. And if there is a market at the time of receipt, you will recognize income at the time that you receive those tokens. So it's not when you claim them in theory, it's actually when you can exercise dominion and control of like an airdrop token. Sometimes airdrops get pushed directly to your wallet, and that's a little different, right? That you automatically see that in your wallet. With the software like CryptoTrader.tax, that you can see the date, the time upon receipt, and what that price was when you received it. But there are some airdrops that you have to actually claim. You have to do something by claiming the reward. And again, that's a little different, a little more nuanced, but technically it's the same situation. Once you have the ability to exercise dominion and control over that asset, it is deemed to be income. And with staking rewards, it's a little bit of a different transaction structure, and there's two separate real main ways that you can earn staking rewards effectively. You can stake, you can like set up a node, let's say, and you're earning income, you're earning rewards, that's income. Or you can use one of these, these DeFi protocols, like let's use Sushi Swap for an example, Sushi, and you can stake like a single side stake and you get X Sushi tokens. That's more like the example where you have to actually claim the rewards, because they are automatically aggregating, but they don't necessarily show up on the blockchain until you actually claim the rewards. But again, it's when you have the ability, in theory, from a tax standpoint, it would be when you have the ability to exercise that control to click the button to claim, is when the income is supposed to be derived. And again, that is a very gray area of the tax because we have no guidance on that. And I want to definitely reiterate that. The IRS has never come up with specific guidance for that single side staking or for those rebase tokens or anything like that. But they do have guidance for normal staking rewards and airdrops that are received, and that is income upon receipt.
Got it. And here's a question from YouTube. I think it's a pretty interesting one. So someone asks, like, if I get airdrop tokens in a new ecosystem and there's no bridge back to Ethereum and USD, but I'm trading within that ecosystem, is that taxable? Jordan, any thoughts there?
So, well, first, if you're, let's say, using like Arbitrum or Phantom or some other protocol, let's say, that has an airdrop that you receive because you've been utilizing something on that chain, and so one platform drops you tokens. In theory, that should have a US dollar value regardless of what protocol you're using, what platform you're using. If there is no market for it, well, then it gets back to that example of the initial airdrop where it's maybe an asset you control, but there's no tradable market. There's no one buying, there's no one selling. But the problem that you would get into with taking that position most likely is if you are trading within that ecosystem, that means that there are people that are providing liquidity for that token, and there is a market. There is a market price. It might not be on like CoinGecko or CoinMarketCap, and it might take a little more work to go and find what that is, but there has to be a market price for an asset that you are using to trade into something else. And even if you don't know what that is, you could effectively assume what that is based on what the price of the asset that you trade it for was. So maybe it creates a basis issue, but at least you'll know what the proceeds are on the subsequent sales. And then from there, basis in a software like CryptoTrader.tax would automatically roll forward, right? You can just keep aggregating and aggregating. It's the initial drop that might create the issue. But that is a great question because that's what a lot of people are doing, more recently, is taking advantage of different ecosystems because Ethereum gas fees are so high and they don't want to pay those fees. So I get that. There's no real answer. There's no real definitive answer. You just have to apply principles and use your best judgment, which David said earlier. But that is, in my opinion, in the structure of the transactions you see, there will be some sort of market price at some point, or there probably was at the time of receipt.
And to follow up, if you're then trading within the new ecosystem, technically, yes, you're triggering disposal events, right? You're disposing of one asset for another, and you are triggering a taxable event, whether you lost money on the transaction or gained money on the transaction. So it's very annoying, but technically, yes. And then JPen, I see here, said, I want Jordan to do my taxes. You can do your taxes at taxing cryptocurrency. But yeah, it's not ideal, but technically that's how it would work for that question.
Got it. So yeah, again, taxing cryptocurrency. Jordan's one of the best in the industry. So let me pull up some more questions. We're getting a ton of questions, by the way. We do have a limited amount of time, so unfortunately we're not going to get through all of them, but we'll try to go through as many as we can. So next one is about NFTs. I did see some people on YouTube asking about this as well. This is a question we got through Twitter. This is an interesting one. This is not one I've heard before. But they asked, do people in certain states need to pay sales taxes if they buy an NFT, similar to the sales tax you might pay when buying a car?
That is a great question, and it's a question that is being heavily looked into by a lot of tax professionals. It wouldn't be, in my opinion, it wouldn't be something similar to when you buy a car, because we actually do have like a digital sales tax in a lot of states in the US, and that would be most likely what it would be attributed to. There's nothing, again, we're on the forefront of these new technologies, right? So we're early adopters. No matter how late you get into crypto or NFTs, you're early adopters, right? There's no definitive guidance on this. There are, and forgive me if this is incorrect, from my recollection, about 32, maybe 33 states that do have this digital sales tax in place. And so NFTs would likely be all encompassed into that sort of rule. But we, again, don't have definitive guidance on it. It creates issues for purchasers and sellers, because who is collecting, who is remitting? OpenSea's not, I can tell you that. They're taking their fee, which is like a sales tax on you, and they're generating money, but they're not, I can promise you, they're not remitting or collecting sales tax. So it's an extremely, extremely weird area of a potential sales tax or a digital sales tax. And that is not something that we know at all. You can maybe make the argument that there should be some sales tax collection, but the problem is you would have to, where is the purchaser? Where is the seller? Are they in California? Are they in New York? Are they in Virginia? Are they in Hawaii? Maybe not, because there's a lot of restrictions on digital assets there. Who knows? So, you do know, the individuals know, but the platform that's facilitating the transactions may not, if they're not KYCing their users. So it is a extremely great question, honestly. There's no answer right now, but most likely, because of the fact that this space is growing so much, there might be something with the FTX, the Coinbase, and all these centralized exchanges creating their digital asset NFT marketplaces. There may be an additional tax imposed on some of these sales in the future because of that very good question.
Mm-hmm. Yeah, it's also not just limited to NFTs or cryptocurrencies. This is a tax problem that plagues just digital sales in general, because as more and more of the economy moves into digital rails, states who used to just collect sales tax based on, if your business is operating in New Jersey and you buy a Twinkie from the gas station, they're collecting and remitting that sales tax. Well, as that moves online, how can they tell where people are, where businesses are based? So it's absolutely not just like a cryptocurrency thing. And this is being, debated and decided by many other parties.
Honestly, the good thing about digital assets for the regulators, in theory, is that it can all be done on chain, right? But you don't necessarily know where these people are. So that's why it gets complicated. You could go by IP address and then say that's where the transaction occurs, but blockchain technology is going to help remittance of tax and receipt of tax for governments, because they will do this. This is not something that they're just going to let us, invest in crypto assets and have all the fun. Blockchain technology is going to get implemented, and this digital ledger will get implemented in a lot of these internal regulatory, processes. But for now, good question, gray area, no definitive answer. Like David said, it's a huge issue, not just in the crypto or NFT space, just in the digital marketplace in general.
Mm-hmm.
Got it. So in terms of what we know about how NFTs are taxed already, is it still subject to the same kind of capital gains rules? Does each NFT transaction have to be reported on Form 8949?
Yeah. So it's, again, another gray area.
The
David and I were
common
actually talking
theme
about this.
Everything's gray.
Yeah, everything's gray. There's no black or white in crypto. It's a weird thing, excuse me, because you have people classifying NFTs, like when they're talking to each other, as, oh, this is like a digital collectible. But some of these NFTs don't look like collectibles. They actually have utility. They actually have function. Some NFTs in the future are not even, the art NFTs, right? When you get into liquidity provider token, in theory, like that's an NFT. When you have in the future, maybe real property being placed on chain, and you're going to have NFTs, right? So the technology is a little bit different. So it's kind of hard to say like an all-encompassing thing. But when you're talking about the profile picture collectibles, right? In theory, if that's a collectible, it's treated the same from a reporting standpoint as it's on the 8949. But if it's a collectible asset, you have to disclose that, and that's something that will result in a higher maximum tax rate. The highest maximum tax rate on the long-term capital gains for now, because that could change also, is 20%. The highest maximum, tax rate on collectibles is 28%. So that 8% is a huge difference, especially when you're talking about, a crypto punk, which could sell for $2 million, and this person could have held it for 3 or 4 years, and now it's long term. Is it an investment? Is it collectible? That 8% makes a huge difference. It's something, again, gray area. We don't have guidance on it, but it's probably which assets are collectibles and which aren't. Making and taking that position is something that you would have to discuss, obviously, with your tax professional and have them do some more due diligence on the specific project that you're involved with. When it's an NFT, that's like the art side of things that maybe doesn't have utility, but you report it the same way. There's just a code that you would code that transaction on you would write a little C on the return, and that's coded for collectible in the 8949 form. So good question. I hate to not give definitive answers, right? But it's just the nature of the fast-paced, environment that we're in.
All right. So we are a little bit over on time. Jordan, do you think you're good for one more question?
Yeah, of course.
Yeah, so this is a pretty hot topic. Everyone on Twitter is talking about it, and it's taxes on unrealized gains. Do you think this is likely to pass? And if it does, how would it affect cryptocurrency?
Well, it probably, I don't know if it's going to pass. There's a lot of back and forth even this morning about a lot of these things. So how would it impact people on a day-to-day? It might not, because in theory, there should be a threshold for where this is at. And if it's really supposed to hit billionaires, right, then maybe that person that bought $8,000 worth of Shiba Inu like last year would get hit by this issue for sure, because they have billions of dollars in that wallet. But it's my personal belief it's bad policy, right, in general, because you're disincentivizing growth in the U.S. domestically for these people that are providing jobs. But yeah, maybe they aren't paying as much in tax, so there should be some sort of additional tax on these people. But taxing unrealized gains, even if you have a high threshold for where that is, it gives you a starting point to maybe move that down and maybe move it down. And then you get into this weird area where we have precedent to tax unrealized capital gains, and we don't really want that. So as a crypto community, for sure, we don't want that, because sometimes we're really fast paced and we're buying and selling bags, and it's not like they're long term anyway. But you don't want that, because it's going to diminish wealth that you're accumulating in a safe haven sort of asset. If you're using BTC as like a savings or a retirement account, or if you're using other digital assets to try to grow and have this life-changing event, but now you're getting hit with unrealized gains tax. First of all, economically, and it doesn't make sense, but it's bad policy to me. So it would impact the crypto space, because maybe some of the larger investors that it could impact based on that dollar amount threshold, if it passes this year, might dump some of their tokens so that they can get rid of that potential in future years. But the day-to-day average crypto investor, at least for now, I don't think it will impact based on the threshold dollar amounts that we're talking about. It's just not, no one wants to see that policy. I don't know anyone that thinks it's a good policy, really. Maybe they want the result of taxing people that have accumulated a ton of wealth that maybe are not paying as much in tax, but I don't think that personally is the right solution. So to answer your question, how does this impact crypto users? Not much for now, but it can down the line, and that's why we should probably fight against, call your representative, make sure that they know that you don't agree with this policy if that's how you feel.
Yeah, completely agree. Took the words from my mouth.
Yeah, well said. Well said. Well, that's all the time we have. Thanks so much for tuning in, and thanks, Jordan and David, for your insights. Now, if you enjoyed this session, hit the subscribe button down below. We'll be doing something like this every month. And if you're looking for an easy way to file your crypto taxes, check out cryptotrader.tax. We've been rated over and over again as the easiest to use solution, and our support team is best in class. They do an awesome job. Well, again, thanks so much for tuning in, guys. Have a great rest of your day.
Thank you all. Thanks,
Take
Jordan.
care.
We'll talk soon.
Take care, guys.